people have different terms for the Series A crunch, or definitions. How we view it, the most basic way to put it is a ton of seed deals have been done over the past few years. As we see here, an increasing amount. And at a certain point, all of these seed companies are going to have to get follow-on funding. And the next step after a seed round is a Series A, naturally. The problem is, Series A rounds haven't been really increasing with the seed rounds. That is to say, it's not like more companies are getting seed funding, and then the same trend goes for Series A. Series A has been staying relatively even. So we have more companies getting seed funding, and now there's so many of them that will need to raise that Series A round, it's not going to be possible. So we're kind of starting to see the Series A crunch, and a lot of these seed companies, unfortunately, will realize that they cannot raise money, and many of them will be forced to exit at valuations lower than their last private round, or will be forced to merge with competitors, or will be forced to shut down. And on this topic, real quick, I just have a few companies I want to point out that have actually shut down, and we're really starting to see this trend, and I think this will happen more and more. HomeJoy was a really big VC-backed company that shut down at the end of 2015. It was a big story. It was all over the news. They had a lot of funding, unfortunately, shut down. And then more recently, we've seen 4 companies in the food space shut down. And I feel like this is one where margins are really tough, and we will see a lot more potentially startups in the food space shut their doors. Spoon Rocket, Dinner Lab, Kitchen Surfing, and Kitchen. So all 4 in the food space, and all 4 probably, I think, within the last 3 or 4 months have had to shut down. It's an interesting trend. And then internationally as well, Beacon, Shopius, there's also Shuttle, and Uber for shuttling kids, had to shut down as well. So I think we'll see more and more companies shutting down there. Just to touch on this, I mentioned accelerators and how many more are popping up, every year. This isn't the number of accelerators popping up. This is actually the number of companies that go through accelerator programs and graduate, and then are looking for that venture funding when they're out. So you see just the rise in the number of companies, and there's a very similar rise in the actual accelerators themselves. There's been a rise, and then we're obviously starting to flatten out here as we move into 2015, and that's reflective of the angel and seed trend of deals going down. Valuations, everyone loves to talk about valuations. Unicorns are a super hot topic. And so naturally, we have some valuation data for you. The reason that in this chart, angel and seed are not clumped together is because, to be honest, tracking angel valuations is really, really hard. It's at such an early stage that we just don't have enough data there to really confidently present it and feel good about that. So we left it at seed, but it is still very relevant to what you guys are doing. I think the most interesting thing here for me, aside from Series B rounds, skyrocketing the valuation, the median valuation, is that blue line at the bottom. So this is the median valuation of seed financings by year, and we see that that number has doubled from 2010 to 2016. The median valuation of seed deals is now equal to the median valuation of Series A deals in 2010. It's only been 5 or 6 years. That's pretty remarkable. Now we get into late stage, just to kind of cap this off. The previous chart was seed and the early stage A and B. And here we have Series C and D plus valuations, and of course, especially the D plus valuations where a lot of these late stage unicorns reside is through the roof. Just wanted to talk about fundraising a little bit and how it plays into here. So there's an interesting trend in fundraising in venture. We've seen deal activity slide for several quarters in a row now, but LPs are still very, very active in contributing to venture capital funds. 1Q 2016, in fact, that $10 billion raised for VC funds, I believe, is a record for any quarter. And we're kind of freshly out of 1Q. As LPs and VC firms report their data to us, this number will actually grow. So I can see this bumping up to $11, $12 billion in the quarter. So it's interesting, why is deal activity going down, but LPs continue investing in VC funds? Well, there's a few reasons for that. I have an interesting idea of why this may be happening. So we have VC firms who in 2014 and 2015 have been funding these unicorns. We talked about burn rates earlier. Well, unicorns have the highest burn rates ever imaginable. They're going through money like nothing else. A big theme in the last few years has been growth over profit. That is to say, boards and VC investors have been encouraging companies to grow, scale, get market share, and not enough emphasis has been put on fundamental financials, making sure you get profitable so that at the end of the day, you can legitimately exit and pay your investors back. So we have VC firms that have invested in these unicorns so much money, and these unicorns continue needing capital. The problem is these VC firms also, although they have massive funds, they can be overcommitted. They can't put too much of one fund's capital into a single investment. So what's happening is some of these VC firms are realizing, to save or upkeep my unicorn investment, I need more money. I can't invest out of my current fund. I have to raise a new fund. So they go back to their LPs, their limited partners, and they say, hey, remember when you gave us money a few years ago? And remember when we invested in these unicorns? Well, look at their valuations now. They're remarkable. They're through the roof. The problem there, obviously, is these are all paper gains. These are not realized investments. And that is part of the big issue in venture right now, is a lot has been based off of the increase in valuation of these companies when they haven't actually IPO'd, they haven't been purchased, they haven't exited, they haven't given money back to their investors. So these VCs are going back to their funds and saying, hey, look at these paper gains, we're doing amazing, more money, and we'll reinvest. And they are raising funds sooner than they normally would to save these unicorn investments, so to speak. That's my take on it. It could be completely off. This could honestly be funds that were in the process of closing for some time, and they happen to close now during this decline in activity. But I have a feeling that VCs really need fresh capital from their LPs, and they will use that to reinvest and upkeep their unicorn investments. I don't have a timer, so I'm not sure how I'm doing on time at all, but I'll try to keep this moving along a little bit. Here, we won't spend too much time on this slide, but it's essentially